Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So ETFs, what are they? Well, they're similar to mutual funds, but are traded throughout the day, as opposed to mutual funds that are priced at the close of trading day, and they're designed to replicate certain index values. So this, I guess they've been around, Mark, from what, early 90s? Is that correct?
Early 90s, yeah. Technically, the first one actually was listed on the Toronto Stock Exchange. I think back in, I want to say like 92 or 93. Of course. Here, everything is measured in terms of SPY, which was the first one to come here. But yeah, I think 17 years strong in 2010 is ETFs in the States. Yeah.
Do you have any clue? I know it's probably changing each day, but you're the expert, or an expert at the IC. Do you have any ETFs are out there? And
there are somewhere between 1,000 and 1,100, maybe a little over 1,100 products. What's actually interesting, though, is that for that, we'll call it 1,100 products that are out there, there's almost another 800 still in registration.
Wow.
So, it's always interesting because a lot of folks in the last year said, oh, I don't know, ETFs, there's too many products, taking too thin a slice of the market and all this type of thing. And I tell people, I say, okay, how many mutual funds are there? And ETFs just in the past quarter or so crossed $1 trillion under management as a vehicle. And let's compare that to the 13 or 14, depending on the day, trillion of mutual funds.
Wow.
So I people who are concerned about that or cite it as some kind of passing fad, and there's too many. Mutual funds have been around since the 20s, 14 trillion in assets under management, and there's considerably more than 1,000 products out there. So that's kind of my 2 cents on that.
Wow, Mark, that's amazing. So it's 1,000 currently, roughly today, or 1,100, and the next time that we do a presentation, it will probably be much higher. The registration process, sometimes it takes months and months, correct? Or
yes.
I mean, get that through.
Yeah, I mean, because ETFs are kind of variants of mutual funds. Mutual funds are fairly straightforward in that if you, and I'm sorry to turn into an investment geek here for a second, but mutual funds, they're relatively easy to put up. You have this set of rules called the Investment Act of 1940, and as long as the mutual fund you put together adheres to those, it's an easy process. You just have to, there's certain registrations you have to do as an investment advisor, et cetera. You do it, you launch your fund, you have your sales force go out and sell. Because of, and we'll get into this a little later about some of the mechanics of an ETF, but basically because of some of the mechanics, the operational mechanics of an ETF, you actually have to apply for exemptions to certain parts of the Investment Company Act of 1940. And they specifically have to do with the creation redemption process, which we will talk about in a little bit. But essentially, what ends up happening is that you make your application to the SEC. You say, I'd like to offer these products. And just by virtue of what you want to do, what you want to invest in, what asset classes you want to use, is it a purely equity-based domestic equity product? That's probably about the easiest exemptive relief, as it's called, to get. As you stray away from that, things get harder, right? So if you want to do fixed income, that's another set of hurdles. If you want to do international, that's another set of hurdles. If you want to use derivatives, nowadays, good luck. And in fact, we've seen there's probably about a dozen or so firms, both new firms and existing firms, who have orders of exemptive relief in with the SEC, and they've basically, the firms have voluntarily, we'll say, pulled them erased any mention of derivatives at all, and then resubmitted them just in the hopes that whatever stalemate there is going on here with approving anything with derivatives, they won't have to deal with, and they can just go about and do their core business. Go back later when things have calmed down, and I don't know when that'll happen with regards to regulators and derivatives, but whenever they feel it's appropriate, once they have their basic exemptive relief, go back and then say, okay, I'm gonna try now so that I can use swaps, futures, options, etc. So generally, in a good season, I don't know, maybe 3 to 6 months for an exemptive relief charter.
Okay.
Once you have that, it then gives you the ability to issue ETFs kind of within the confines, if you wish, of what you asked the SEC to do. So if you get your exemptive relief, domestic equity, then domestic equity products you can launch. You still need to have a review process for the individual products, but it's not nearly as onerous as getting the initial exemptive relief. Right?
Makes sense. All right, Mark, do you want to handle that, the ETF creation? Do you want to just, I guess, summarize it, or you want to take it point by point?
Yeah, well, we already kind of covered the first one here. The sponsor or the issuer will make this application. They'll be granted it. They can now go out and manage the portfolio, market it, etc. The authorized participant, generally, your primary market maker is going to be your initial AP, as it's called. And so what ends up happening is that you have the fund, you find a specialist or a primary market maker for this product. Generally, what happens is that they will put together seed money and launch the fund with that. And what they generally do is they will make put together a basket of about 100,000 shares of the fund, which is equal to 2 creation units. And creation units we'll talk about in a little bit, talking about creation and redemption. But say a fund comes at $20. There's 100,000 shares, it's $20. Somebody has put up $2 million to purchase all the shares in the right amounts to effectively track the index. The fund gets listed, it starts trading, and at this point the primary market maker really is the market for those shares. And basically, as demand starts to outstrip the supply of shares, the market maker will go out to market and put together another group of stocks, basically another creation unit, will go out and buy the stocks that, as prescribed by the index, such that there's enough that equal 50,000 shares of the ETF. So, like a mutual fund, cash comes in, shares are put together, underlying stock shares are put together, and then what comes out of it is shares in the ETF. Unlike a mutual fund, this is done outside of the fund complex. So in a mutual fund, you send your money into the mutual fund provider. They have traders that go transact, buy the portfolio, and then you get your shares. Here, it's the participants in the fund, the authorized participants, that will go out, create these baskets, and then deliver them to the issuer, who will then give them back the shares, which increases the float. Again, unlike a mutual fund, this can happen in real time. So you can have a creation unit go off in, the beginning of the trading day, the middle of the trading day, whenever it's needed. There's no kind of wait for liquidity. And so as the fund grows, it's not only just going to have one authorized participant, it could have many. And it kind of makes sense. If I have a fund and say Morgan Stanley, it gets on their platform and their clients start trading it, it makes sense that there's a desk at Morgan Stanley that will go out, put together these creation units, and then deliver them. Because quite frankly, there's spread to be made there between the value of the stocks in the creation unit and the price of the ETF itself. And that gets into, again, another part of it, which is this arbitrage mechanism, which allows the ETF to closely track what's going on in the index. Let's see.
So, Mark, participants, there could be multiple authorized participants,
Correct.
and they're actually, they have a relationship with the fund manager then, because the fund manager is the sponsor, and they're the ones that are actually, they create that was their original idea, correct? And
Correct.
The participants are the ones that are actually facilitating this process, making the markets.
Yeah, well, they're not necessarily. I mean, the specialist is the one making the markets, but what ends up happening is that think about it in terms of a equity, right? I have an initial offering in an equity. My float's say 100,000 shares. Those shares trade, and they trade on the fundamentals of the company, but there's also kind of a scarcity value there as well, because there's only a limited amount of those shares. If I want to, as an operating company, go out and get more shares of my stock, I have to go and issue them, right? In an ETF, as I said, as demand outstrips supply, in other words, if I have a fund that, say, trades 50,000 shares a day, and somebody comes in with an order for 200,000 shares, right? That 200,000 share order is not going to just sit on the book and throw that market out of whack. What ends up happening is that the person bringing that trade is going to either themselves or with an authorized participant actually deliver all the stocks, all the basket of stocks necessary that equal those 200,000 shares. And they'll just basically give it to the fund company and say, here are all the stocks you need based on what's in your fund that are going to equal the 200,000 shares that I want.
So that sort of brings us to the bottom bullet point, to create and redeem sort of process?
Yeah. And that creation and redemption process is it's fundamental to ETFs, because it does so many things to differentiate them from mutual funds. It strips away a ton of cost for the issuer. It provides, as I said earlier, it provides an arbitrage mechanism such that the ETF can trade in line with the underlying index, right? And frankly, I don't know if people are aware, but there are a lot of desks out there. All they do is they basically they arb away the difference between the real-time price of the index and the market price of the ETF. So shares of an ETF trade for $10. This is an extreme case, but shares of the ETF trade for $10. But I can go out and buy that same basket of shares effectively for $9. So I go out.
In the real world, it's going to be more like $9.98, though.
Yeah. Or it could be as wide as 10 cents, 8 cents, something like that. It's not going to be huge, but it's enough. It's enough that kind of desks with scale and access can go out, put together these baskets, and deliver them. It's not something you need to do with SPY. But for some of the smaller funds out there, those opportunities are there, So, and in fact, this whole thing, I can kind of see people's eyes glazing over already. But we'll have later. There's a whole thing about ETF liquidity, what it really means, how the creation and redemption process really works. We can certainly put together a seminar just to talk about it, because there are lots of things that go on. Lots of opportunities for different kinds of players, and then as well some things that kind of your average investors can pick up on and really use. I think a lot of people look at volume numbers on ETFs and get afraid that, well, I can't trade that. It only trades 18,000 shares a day or 40,000 shares a day, and I don't know. We'll talk at another seminar about why that's an unfounded concern, certainly
What do you
with
call
any.
that, Mark? I know you've mentioned it to me in the office. Liquidity.
Oh, well,
Look
look through liquidity.
Yeah.
You know, there's your top line liquidity of what the ETF itself is trading, and then there's the look through liquidity. What are the components of the ETF trading? And a lot of times you'll find when you're comparing, you know, heavily traded funds with funds that are in the same space but are much more lightly traded at the ETF level. Once you go through and start looking at those components, there is no difference. And in fact, sometimes the fund which appears to be less liquid actually is more liquid when it comes down to the component level. So
Mark, if I'm a novice investor and I have most of my portfolio in equities, should I be afraid that I'm getting sort of ripped off by these ETFs, or do you think the arbitrage is pretty much in line and I shouldn't have to worry about that all that much?
No, you shouldn't have to worry about that. Another thing too, and I always tell people, and I think Steve, you do as well. You know, if you're looking at the market for something and it looks a little too wide for you, don't forget a quote is just that. It's a quote. It's an indication of price. It's not something that you have to. You know, you don't have to. You know, lift the offer. Go for somewhere in the middle. Put in a limit order. You know, so that's kind of that. You know, again, it ties in with liquidity. Well, geez, this thing is, you know, 8 cents wide, and there's a competitor product that's 3 cents wide. Okay, well then don't lift the offer. Why don't you put in something, you know, instead of being, you know, 4 cents away from midpoint, put a penny away from midpoint and see what happens. You know.
Well put. That's a very good point. So, do you want to handle that, the benefits of ETFs, Mark?
Sure. Flexibility. Actually, we've talked about that. You know, there's lots more asset classes. There's lots more different slices of the market that everyone has access to. The cost of transacting, of course, with ETFs, no 12b1 fees, no trailing commissions. You know, it's the cost of a trade, of a regular equity trade. As well, the expense ratios are much lower. There's some numbers here I did. There's a presentation I did, albeit about a year and a half ago, so the numbers are a little stale, but you get the idea. You look at the U.S. domestic equity mutual fund marketplace. At the time, there was about $5.6 trillion invested. Average mutual fund expense ratio on those assets was 140 basis points. The average ETF expense ratio at that time was about 36 basis points, which is a 104 basis point difference. All right, and when you think about it, well, when you run the numbers, that savings, if all those domestic equity mutual fund investors switched over and started using ETFs, they collectively would put a little over $59 billion in their own pocket. Okay, so
to remind everyone, 100 basis points is 1%. Is that correct, Mark?
Yes.
So that, for those of you that are novice, you know, Mark's talking about the basis points is very, very important, and the idea is that you might be able to put some money into your pocket by finding the lower cost, lower expense areas to be in. So that's very, very important.
Again, the third point here with diversification. Again, you know, we talked about that too. That there's just lots of different cuts of the market that you can get into now with ETFs. This last point here with the relative tax efficiency of index funds, again, it gets back to the creation and redemption process. Basically, because of the creation and redemption process, the managers of the fund can better manage the tax exposure. They have more opportunity to take offsetting losses when they're selling gains. And that's a very kind of high level look at it, but that's essentially what is going on. There is more opportunity for investment managers to neutralize the effects of capital gains exposure. So,
a few disadvantages. Obviously, some of us you don't have to overtrade. This isn't necessarily a disadvantage, but just a reminder that if you're overtrading, if you're trading every millisecond, that could be a problem. And when we talk about lower diversification, it doesn't mean that you're going to be 100% diversified. It always depends on ETFs that you choose. And I think this is to Mark's point. Mark made an excellent point about you have to look at the goals of the ETF. So if you're trading triple longs, triple shorts, that product was not built as a buy and hold product. So you really need to know what was the goal of the specific product that you're considering investing in, and to understand what the components are and how they're priced and what might happen. Any other points on that, Mark?
No, I mean, again, it's so much of this business is kind of caveat emptor and all that kind of thing. So, can't stress it enough. Know what you're getting yourself into, right? That's that. Again, the last point here, it really ties. The last point ties in a little to the second point too. Just not saying that you need to go through and read every prospectus so you get your hands on, although I would recommend reading through at least one. If you can make it through one, if you're really looking for a cure for insomnia or something, try it, if only to say that you've done it and that you then can understand really the mechanisms behind it. Because the prospectus and the SAI as well, the one thing that they do, albeit in a very dry and boring way, is truly explain exactly what's going on in the fund, what the mechanisms are, what the goals are, how they're achieving them, and all of that sort of thing as well. So, try anything once. Try reading one prospectus cover to cover. See how it goes.
That's a good point. So there are lots of ETFs, types of them, equity, bond, currency. I think I've gone through this, REITs, commodity leverage, many others. And I guess this is back to Mark's point, is know what you're investing in, whether it's the mid-cap, small-cap sectors, emerging markets. Just know what you're investing in. Know what you're considering. What are your goals? And then also what are your risk tolerances, and go from there.
Yeah, if you're, everybody's on the commodities bandwagon the last, say, half a year or so. If you get into one of these commodity funds, what are you getting into? Is it a physically backed fund? Is it futures backed? Does it provide commodities exposure through equities? There's a bunch of different ways that you can get exposure to commodities, and they all have very different outcomes. So.
Good point. So you can use options. So everything, just about everything that we do in equity options, you can do with ETFs. In fact, back to Mark's point, is that because these are products where there are so many components, and Mark's going to actually come back in a future webinar and do a webinar and look through liquidity, that the options tend to be very, very liquid, because it's much easier for a market maker to hedge, an options market maker to hedge most of the ETF products, rather than, I like to call it, some esoteric biotech company where the company might come out with a cure for some sort of eclectic disease or incurable disease. However, if they don't, then the company might be worthless. So that company might not have any liquidity, not only in the underlying stock, but in the options. And when you're trading ETFs, you're going to probably see a lot more liquidity. You can trade covered calls, spreads, whether bullish or bearish, or volatility positions. In fact, I'm going to come back over the next couple of weeks and talk about some of those strategies. Today, we're going to keep it at a very simple, high level, though. All strategies work. They just don't work all the time. And I'm the resident expert on option strategies at the ISE, since I'm the Director of Education, talking about options. And the most important thing is almost the same point that Mark just made on ETFs, is know what you're investing in, know the risks of a certain strategy. So it's not enough to say, I'm going to do this volatility position because I'm going to make money if the market moves. But you want to think, what if the market doesn't move? How is that going to affect my Vega position? And therefore, I might lose money, not even at expiration, but a lot of money quite a bit before that, because of changing market conditions. So understand how changing market conditions can affect your option strategy. When we're trading options, we look at calls and puts, single leg options, if you will, covered calls, protected puts, collars, verticals. I'm going to handle all these in the next few seminars or webinars. And it's important to understand what the risk is in each one. Whether it's a single leg one, you're just you have a debit and that's it, and you're looking for more volatility. Covered call is more of an income strategy. Protective puts would be a strategy where you're insuring your underlying position. Then there's a collar strategy, and there are other vertical spreads.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.